We often make investment changes to enhance potential returns, lower downside risk, or reposition for an upcoming withdrawal. And making a change in a registered plan like a TFSA or RSP is straightforward. Just sell and buy. No fuss, no muss. In a non-registered account, there may be a capital gain to be considered, which could translate into a tax bill or even a one-year loss of old age security. So what seemed like a no-brainer in your TFSA now feels much more complicated, even punitive. So the bottom line question, does it make sense to take one step backwards, that is, paying tax, in order to put you in a more optimal investment mix? We often like to say we don't want tax to wag the investment dog, but we can't hide the fact that tax is a reality and it needs to be considered. Let's look at an example. Dennis Smith, to get a sense of things. Suppose Dennis has a $1 million RSP. We present an investment opportunity to switch to an investment poised to return 7% instead of his current 5%. Forecasting this out, in 10 years, the account could increase to $1.84 million instead of under the current investment of $1.55. I've got no doubt that Dennis would tell us to go ahead. Now, Dennis also has a non-registered plan with $1 million in it. The account has an adjusted tax base or adjusted cost base of $600,000, meaning he would realize a capital gain of $400,000 if we made the move. Of that $400,000, based on today's rules, 50% is taxable. That $200,000 would then be stacked on top of his other incomes, and assuming that Dennis is in the 50% marginal tax bracket, he would have to pay $100,000 in tax. So, conceptually, after Dennis pays the tax bill, his $1 million is now $900,000, a lower starting point. So, does it make sense to take one step backwards to return 7% instead of 5%? Can you feel Dennis becoming a little bit more apprehensive compared to his RSP decision? I can. There are two dimensions that we need to look at to get a fuller perspective. I call the first the statement view, while the second is called the in your pocket view. The statement view is what you see on your Asante statement each quarter, each year. Have a look at this mock-up. The other figure is your in your pocket view, meaning what is actually yours after you pay the tax man. For Dennis, his $1 million statement view translates into a $900,000 in your pocket view. Make sense? Let's keep going. Let's have a further look at the statement view. The chart you are seeing is the comparison between the 5% investment in light blue versus the 7% investment in dark blue over the next 10 years. What we see is that it is only in year 6 that the 7% investment overtakes the 5% one from a statement point of view. So, do you have to wait 6 years to feel good about your decision? Now, let's look at the in your pocket point of view. Again, looking at 10-year comparison, we can see that the 7% investment overtakes the original 5% after year 1. Again, this is from an in your pocket point of view. So, which is paramount? Which one's more important? The statement or the in your pocket point of view? Well, they both need to be considered. And of course, there are no guarantees the 7% will come to fruition. So what determines the break even? The two determinant variables are the relative size of the unrealized capital gain and your marginal tax rate. The larger the capital gain, the longer it takes for the new investment to overtake the old one from a statement and in your pocket point of view. Similarly, the higher your marginal tax rate, the longer it takes for the new investment to overtake the old one from the statement and in your pocket point of view. Paying tax is no fun, especially when you're the one pulling the trigger. At the same time, if the investment change has material merits, taxes should play a second seat. As always, if you have any questions, let me know.